It's Friday, October 3rd, and you are about to go on the markets with Sonoma Wealth Advisors and the Fermata family of brands. My name is Dano, Weir. I'm the marketing director. I'll be joined shortly by Chris Sipes, CFP, Daren, Blonski, CFP, our managing principals. Today, we are looking at what we're calling the virtuous cycle, how cycles kind of, you just sort of wake up and you're in them and you don't necessarily know how they started or when they're going to stop because it seems like they just are feeding upon one another. It's a government shutdown right now, so clearly that means that everything's going up. We're going to look at that. AI companies have high valuations. Okay, what historically has that done for the stock's performance? And Daren is already frothing at the mouth. Jump in and talk about a bounce back for Bitcoin. Guys, welcome into the show. And Daren, you've done so many victory laps. Is there something more you can do than, is there a parade? Do you throw a gala event? What is going to happen when Bitcoin hits another all-time high?
No highs, no lows, Dan. You just keeps on moving. I actually don't get that excited about it or care that much about the downs or the ups. When you like the fundamental schematic of an asset, you just let it roll. And Bitcoin doing Bitcoin things keeps on clipping upward. So I don't know if I'm going to throw a gala event or anything, but I think, a wise mentor in our business long ago taught me that no highs, no lows, just stay the course.
Makes sense.
I'm not going to be throwing a party anytime soon.
What would happen at a Bitcoin party? Chris, tell me what you mean by this. We always have a discussion pre-show about what we're going to talk about, what our theme is, what we're feeling in the market and the economy for the week. And Chris, you threw this out there, and I love this phrase. Explain to me what you think the virtuous cycle is.
Yeah, so it seems like in the market right now we've got this cycle that's feeding on itself, which is that the market's going up, which we'll see soon that most of that wealth is held in a certain segment of the population. That segment continues to spend because the market keeps going up and their portfolios are doing well. That spending just keeps feeding through to the various parts of the economy. And even though we've seen struggles in employment, we've seen struggles in different areas of the quote unquote real economy, delinquencies going up on student loans, for example. It doesn't really matter from an economic standpoint, from the economy standpoint, at least in the short term. Because much like the stock market itself, it really only depends on a small segment of the population, continuing to do what they do, that affects the market and the kind of top line numbers in the economy.
We are your hosts today. We're from Sonoma Wealth Advisors, then Fermata Advisors, the Fermata family of brands. Daren, Blonski, Chris Sipes, myself, Dano, Weir. If you're new to our firm, you can learn more about our private wealth at sonomawealth.com, our private wealth service. And Chris, let's start it with a meme. Your boy Sam Altman.
Yes, I saw this meme and it just cracked me up. So Sam Altman is the head of OpenAI, right? And the meme says, "Just need 200 more trillion and all your fresh water and electricity." And that seems to be where we're at. The AI beast is being fed. And, we talked last week about the different companies that are just pouring so much money and so much CapEx into this, and how it had been just funded out of cash flows. They're starting to do that out of debt now. But it's all, pedal to the metal. There was a recent interview with Jeff Bezos talking about the fact that he thinks, likely we are overbuilding, but it'll end up being a good thing for society in the end, which is probably true. Given that most of the time with technologies, we kind of we over-allocate, we overbuild, and then the benefits come later on down the road, maybe a little bit later than what we might think. But as of right now, we're talking about building these data centers. We are talking about we need extra electricity, we need extra water. I mean, all this infrastructure to feed this beast that is AI that we are all in on at this point.
So there was this post on this topic that I think is pretty important, and we're making jest of this and fun of it, but the reality is, this I think is the biggest linchpin that will determine whether or not this AI boom can go, and then how it ends and what the future holds for it. And so there was this post I posted on my X account earlier, but it was a Google employee talking about DeepMind. And so DeepMind is Google's AI large language model. And he said, the longest pole in the tent to get data center built is power, just lack of power. The supply chain has been largely solved. The contracting issue we can really solve for. The permit issue we can solve for it. The power, lack of available power, reliable power has become the biggest bottleneck for us. Utilities, they were not ready for this because they're upgrading. They're bringing on the sensitivity for gigawatts or something like that. Power is by far the biggest determinant. Once you solve for power, then it's pretty much a standard data center built. After that, it's permitting. Permitting is not really a bottleneck. So anyway, he's just going on and talking about like the bottleneck here is power and the ability to draw power. So like we make jest of fresh water and electricity, but at some point, the demand from the AI world becomes so strong that it pushes all the pricing up for power for us just to live our day-to-day lives. And once people complained about Bitcoin and how much power Bitcoin took, no longer, because AI is powering, is taking more power than anything. It's said that the new Giga facility that Elon Musk is building in Texas is going to take up the equivalent of the power for a medium-sized state on a daily basis. And you think about it, like that's insane amount of power. And so where's it going to come from? And at some point, it's going to jack all our power prices up. And they're going to have to like set some type of government limiting on it. Otherwise, there's going to be a lot of unhappy voters.
I had an interesting perspective on this week too, because just as the announcements of all of these massive data centers that they're building, which by the way, it's not like we had zero to begin with. I have worked in a data center in my life, so I've seen some of them in person, and there are many data centers that exist already. So the fact that they need even more tells you the scale of it. But just as an interesting other side of the coin, this week, did you guys see that there was some massive solar array in it's like in the Mojave or something like that? It was a massive set of mirrors that they spent like $6 billion on 10 years ago to be like the California solar farm, basically. They're closing it this week because it's not making enough power, and it apparently caused a lot of birds to die because birds were like thinking that it was the sky. So it was a major issue with killing birds, but also affecting the grid. Anyways, long story short, I can just imagine that in 2015, we would have seen a news release about this huge build out. It's a $6 billion build out. It's going to be the solar this and it's going to be the solar that. And so guys, when we're doing this show in 2035, I'm going to pull this clip when they're closing one of Elon's data centers because it didn't work out. And we can all look back and say, see, interesting.
You're always such a pessimist, Dan. Like, what's up with that, man?
I hope our AI overlords remember to reference this.
That's right.
This episode. So we, amongst all the news, we got a government shutdown this week, and the market did not seem to care whatsoever. Now, if we look back at previous government shutdowns, that's kind of been the case. This is looking back to the 1980s. And what the returns have been in the S&P, around government shutdowns. And gosh, look at December of 18. So it seems like we've had kind of more often. We've had this the last several years, but But look at December 18, we actually did pretty well when the government shut down. So we'll see. But in 7 of the past 10 shutdowns since 1980, the S&P 500 actually generated a positive return, showing markets have often looked past the noise, which I think, incidentally, I want to say the average is right around there anyway for the S&P, being up around 7 out of 10 years anyway. So it doesn't seem to be correlated, meaning, a government shutdown doesn't equal good or bad for the market. It really doesn't seem to be something that the market even cares about, strangely.
Well, it's what is interesting about this shutdown that I will mention, it's being used strategically, it almost seems now, by the Trump administration. What has me more concerned is the job losses. I think the job losses is building. We were supposed to get a jobs report out today, but it would seem that they're going to use this shutdown to really lay off a lot of people and get rid of some positions. And I think there's more brewing underneath, just anecdotally and talking with clients and individuals, that's happening in the job market right now that I don't think's certainly not being represented by the stock prices, the gold prices, or the Bitcoin prices.
Totally agree. And that goes with the whole theme around the virtuous cycle. And this illustration from Visual Cap is a perfect representation of that. When they put an actual, pumpkin pie, which I don't know, are you guys pumpkin pie fans? I certainly am a pumpkin pie fan. I think it's maybe number 2 or number 3 on my list, behind rhubarb. Rhubarb would be tops for me, but I think pumpkin's probably right up there. Yes.
Chris, it's not rhubarb, is it really?
Yes, rhubarb pie is my favorite. What's wrong with that, Dan?
No, nothing. I am a pumpkin fan, but it's got to be high quality. Don't give me the can.
Yeah.
Really?
Okay.
I think some of the best ones are like the one that, that's you walk into Safeway and it's just sitting right there and it's just a classic pumpkin pie, nothing special. And there's something about a pumpkin pie in the morning. Have you ever had pumpkin pie cold?
Yeah.
It just hits.
That's how I feel about the cranberry sauce, Daren. They give me I do need the ridges in the cranberry sauce.
Yeah, we got a little time before Thanksgiving, but it is, pumpkin spice season. It is the fall. So anyway, pumpkin pie. So we totally got distracted here, guys, on what the actual chart is showing us, which is that Americans' wealth by generation. And you can see there that biggest slice of the pie is the baby boomers with 83.3 trillion of the assets owned, roughly half of the financial assets, followed by Gen X at 42.6. That would be roughly about a quarter of the pie I see there. So, like the market and its concentration, when I talk about the S&P, very concentrated, so is the wealth in the United States, at or near records in terms of the wealth. I hate to call it inequality because it triggers so many people, but I would say wealth concentration. Most of the wealth is concentrated in the baby boomers and in the top, call it 10% of earners when it comes to income. So, you've got two things. You've got the income, which is one thing, and then you've got wealth, and this is talking about wealth. So this would be like accumulated assets. So those are two different things. But when the market goes up, when we have healthy returns in the market, those that own those assets feel more comfortable about buying things like houses and cars and doing remodels and going on vacation and things. And that it continues to kind of fuel the markets. And this isn't my idea. This is Ed Yardeni of Yardeni Research. That's his whole thesis on the Roaring 20s, is that the baby boomers are in the best wealth position in human history, essentially, and that they are just going to continue spending through pretty much anything, and that is going to fuel both the markets and the economy moving forward. And at least so far, he's been pretty spot on with that thesis, it seems. All right, so we've got a Simpsons meme, my favorite. You combine the memes with the Simpsons, and I'm in. And the meme says, literally the worst year for value investors, and it shows Bart cringing, and then Homer comes up and says, worst year for value investors so far. So been a real struggle for investors that, traditional value, and I gotta say value can be determined many ways. There's many metrics that you could look at value from, and so I think the chart that this was in response to was probably referencing the Russell 1000 value versus the Russell 1000 growth. And at least in the United States, value, which is essentially you're trying to buy something for less than it's worth. You're trying to buy $1 worth of value for 70 or 80 cents. That style of investing is having an awful year relative to growth investing. Now, notice I said in the United States, because outside the United States, value is doing extremely well and has for many years. It's really just been within the United States that value investing has struggled so much recently. But anyway, sometimes you got to laugh to keep from crying, guys.
Well, and this plays into the idea of today's theme, which is, the cycle. So you've got the smaller companies which are not doing well, and so the money goes to the larger companies which are doing well. Why would you go to the smaller companies who aren't doing that well when you could stick with the larger companies who are doing well? Like, it is because it is until it changes. But when's it going to change? Who knows?
Right. Yeah. That narrative is really important. And we've got the updated guide to the markets from JP Morgan this quarter. They put that out quarterly. And some of the best, research out there. It's really great if you get some time to flip through that guide to the markets. And they're showing here the updated S&P valuation measures. And this is, at the one on the chart is the price to earnings ratio, the forward price to earnings ratio, which is currently at 22.8 times. Which is much higher than the average, the 30-year average at 17. You can see we're outside of standard deviation in terms of that valuation. We are now, it looks like, higher than we were at the end of 2021. We're only exceeded one other time, and that was the dot-com bubble. But you look at these other valuation metrics, the CAPE, which is the cyclically adjusted price to earnings. So it looks at it over 10 years, same thing. Dividend yield. I think the dividend yield on the S&P is approaching 1% now on the downside. So that's very low in terms of the dividend yield. And then you've got valuation spreads, expected yield on the S&P minus a junk bond, the BAA yield. So I mean, it's hard to slice it any way and say that the S&P 500 is cheap at this point. I haven't seen too many metrics that would argue for that. I've heard a lot of this time is different, but I haven't seen anybody say, "Yep, no, look on this metric, it's actually really cheap." And then this is also from JP Morgan, furthering that, showing that the price to earnings ratio and equity returns, both 1 year out and then 5 years out. The correlation they're showing that we should be, expected returns on the S&P over the next 5 years would basically be zero at this point, based on those valuations.
So, Chris, let's be super fair with valuations, and I think it's important to point out. I distinctly remember a conversation of you and I sitting in the office. I guess it would be 2019. Talking to a client about valuations and then looking at like Vanguard's predictions and BlackRock's predictions and of what the moving forward likelihood of return is. And it was like same type of thing, abysmal. And yet the market's just ripped. right? So I think it's just super, super important to point out that, like, yeah, you could take away from the slide the feeling that things are overbought and returns are going to be awful for the next 10 years in the stock market. And you could also take away and say, well, yeah, but that's what they said 10 years ago too. So I think you have to be cautious. And I think, again, the case for diversification, you don't know. Nobody knows. And there's no indicator that it's 100% right all of the time. And that's why you have to spread your risk and invest in a way that you win in any scenario. You might give up big wins, but you get little wins.
So true. And that is a perfect segue to the next slide, which is valuations are a poor predictor in the short term. And here it's showing the 1 year annualized return prediction of the S&P. And the takeaway is the data highlights that relying solely on the forward price to earnings ratio for short-term predictions may not be a reliable strategy. And yeah, may not be a reliable strategy is an understatement. It is probably most likely, we can't use absolutes, right? But to your point, Daren, yeah, it's not a timing tool, and definitely not something you can bank on for sure. And so therefore diversification is what makes sense. And I think it's just keeping in mind a lot of those forward predictions too, when you're looking at, say, 2019, 2020, etc. Those are 10-year horizons. So we still have some time, for those things to play out. And a lot can happen, in the short term. Like if you thought about that same prediction in the year 2000 or 99, let's say 99, the last time the market was this expensive. And then you're reviewing those predictions in 2006. You'd look at that and you go, oh, well, they were way off. The market's actually done really, really well. Well, 2007, 2008, the market corrected severely. And so that 10-year prediction ended up being correct in those cases. But it takes 10 years to play out, or 8 years, right? And we just, you can't know. You can't know for sure. So you're exactly right. Don't use it as a timing tool in the quote unquote short term, which is really anything less than 10 years. Now, going back to the virtuous circle, and just to point out basically how good a position the average consumer is. We spend a lot of time talking about how poor of a position the governments are, but the consumer is in an excellent position. And we're looking at the consumer balance sheet, again, from JP Morgan, and the breakdown of their assets. And homes tend to be about 27% of the assets, but look at other financial assets at 44%, which is why whatever's happening in the market is so important to what will happen in the market and what will happen in the economy, because you're almost at half. And if you include pension funds, which is also has an exposure to the market, well over half of people's overall balance sheets are invested in risk assets. Now you look at the right hand side, household debt service ratio, very low. Relative to history, lower. It's only been lower during the pandemic, which I think I could be wrong, but I think we reached maybe an all-time low during the pandemic in terms of the debt service ratio. And that is basically like how much debt can you handle versus how much income do you have. And when we say debt, we're talking about minimum payments. So if you make $1,000 a month and you have to make $100 a month in payments, that's a 10% debt service ratio. So now look at the chart at the bottom though, where you look at flows into early delinquencies, and you can see that we're back to pre-pandemic levels in delinquencies. Not anywhere you would say is alarming, except for the student loans one. I mean, look at that thing just shot up. Of course, there was no delinquencies when nobody had to pay student loans, but then as soon as those came back online here recently, the delinquency level has shot up there. And so, going back to the pie, the younger generation having a much smaller part of the pie. We've talked about how they're also struggling to find jobs, and now the student loans are coming back on online. So, but again, when you look at overall wealth, overall income, they just don't make up a big enough part of the market to make a difference yet. So,
yeah, Chris, I got to ask you about the household debt service ratio, because this is showing that that's historically relatively low, but could that also just mean that everybody's just making the minimum payment? Because we've seen a number of times that credit card debt's at an all-time high. So does that mean that perhaps families have just resigned themselves to, we'll just make the minimum payment and not even taking away at the principal? I mean, not that but you know what I mean? Wouldn't that be a little misleading?
That's part of it, and part of it is that the all-time high, quote unquote, is misleading, because they're talking dollar amounts in most cases, which, yeah, the dollar amount is an all-time high, but like the percentage of this balance sheet over here, right? And also, again, to the, like, which part of the market are we talking about? Like, I'm sure for the bottom half that's struggling to make it, there probably is a huge portion of their overall what they're owing. But when you look at everybody in general, and to kind of conceptualize this, think about yourself in a room with 10 other people, and one of those other people is someone very wealthy, right? To make it extreme, think of it, Bill Gates is in the room with you, and Bill Gates and 8 other people are in a room, right? Now, if you look at like the average of that room, you're going to look at this balance sheet and go, wow, things don't really look too bad. But when, 7 or 8 of those people are like, well, I don't have anything, and I owe,
right.
I owe everybody and their mother,
right.
So that's what I'm saying, is that it can look distorted based on that concentration of the wealth. Hopefully that makes sense.
Yeah, makes sense.
So we got the sentiment indicators this week. Not really much has changed there in terms of the AAII indicators. The CNN Fear and Greed Index is the same, about 54, which is about the same as last week. But Bitcoin, we went from fear last week at 28 all the way up to 63 greed within 1 week. And obviously that's following the price jump, which makes sense, and so that one, to Daren's point, if you're someone that is an investor in Bitcoin, especially someone who's been through, a long time of owning Bitcoin, you really probably don't get excited about these ups and downs anymore, because it swings week to week, right? So it's a good numbing device. Sorry there, Dan. So just to revisit our environments again, so we kind of burn this in our heads of what economic environment are we in. Gold continuing to do extremely well. Silver extremely well. Bitcoin extremely well. So, and if you look at this chart, which environment does gold tend to do the best in? What environment do commodities, hard assets tend to do the best in? It's inflationary booms. And so, and you've got equities doing well as well, and equities are positive in this environment, just not as positive as those hard assets. And so I would argue that with most assets up this year, it feels like we are in that inflationary boom segment of the environment today. And to back that, one data point would be from Liz Ann Saunders, the chief investment strategist at Schwab. She says, not a perfect relationship, but CPI, which is the orange, this is the consumer price index year over year, which is widely considered the inflation gauge, the main inflation gauge. in orange there, has tracked with a lag prices paid component of ISM manufacturing, which is the blue line here, over the last 10 years. She says this suggests continued upward pressure on inflation. And so gold has got to be foreshadowing something. And you would think that could be it, right? So if we continue to see inflation kind of creep back up, that would make sense. And of course, the market is going to price this in ahead of time.
Well, the other argument too, real quick, for gold going up as much as it has is if you look at what's happened to the dollar this year, and the value of the actual dollar has been absolutely abysmal, right, and decreased. And so in theory, then those assets could flow into gold, and gold is more valuable against the dollar because of the value of the dollar going down.
Yep. Gold being money over, millennia, and the dollar being a fiat currency. My daughter said something that cracked me up the other day. She's 8, and she said, Dad, it's so weird that all of us care about pieces of paper. And I said, what are you talking about? She's like, money. It's just a piece of paper. Why do people care about it? I was like, that's actually a really good question. Very good philosophical question there. And the answer is that because we all think it is worth something and we all accept it as worth something, right? And with fiat currency especially, that something is changing all the time. And recently it's been worth less and less, right? And so what are we looking at here? This is the 10-year treasury and the 30-year mortgage since the Fed cut rates on September 17th. You can see the treasury rate has been a little noisy, kind of up and down, and most recently down. However, the mortgage rates have been pretty steady, just continuing to climb. And it's way too early to tell. This has only been a few weeks, and so this is purely noise and conjecture at this point. But going back to the inflationary thesis, fixed income, bonds, treasuries, mortgage rates, etc., are going to bake in some sort of inflation assumption, right? And if bond investors, if lenders, debt holders are expecting inflation to go higher, then you should expect the market to set interest rates higher no matter what the Fed decides to do, unless they decide to do something like QE or yield curve control or something that's going to actually affect the longer term rates. Until they do that, they are just controlling or have influence on the short end of the rates, which doesn't really affect things like consumer credit. And so we talked a lot about that last week, about why that makes sense, why you need to take a look at your cash investments, because those are on the short end, and that the long end is, at least right now, baking in more inflation as the expectation. All right. And those interest rates are going to have an effect on home sales. And this is from Lance Lambert, by way of Residential Club. Residential Clubs puts out some great charts on the real estate market. And Lance says turnover remains very low in the existing home market. In fact, you'd have to go back to August of 2010 to find an August with fewer existing home sales than in August of 2025. I mean, that's pretty impactful. You remember August of 2010? That was pretty close. I think the housing market bottomed in 2012, I believe. But remember the housing market back then. Wow. Ghost town, right? In hindsight, totally wish I would have been buying with both hands at that point. But
I'm gonna reach out. I'm gonna reach out from the internet right now and say that's how it is right now. I'm like, right now, the inventory that's out there, I feel like it's similar to 2009, 2010. It feels like
yeah. We just haven't seen the prices drop like we did back then. Of course,
yeah, that's true. That's true.
And we've got record, housing unaffordability based on that debt to income ratio. So even though consumers are in great shape as a group, home buyers, it's very difficult. So going back to that debt service ratio, banks want to see you under 40, under 30, ideally under like 25 to be able to afford a home. And with interest rates the way they are, and so far they've just been creeping up higher, unless housing prices drop, that is going to continue to put pressure on the housing market. Now, notice this is existing homes. This is not new homes. The new home market is a different market. And I don't know of another time in U.S. housing history where there's been more of a bifurcation between new homes and existing homes in terms of supply, the market, how it's working, functioning. But for all intents and purposes right now, the existing home market is locked up. All right. And so, Daren, your point about gold, in terms of, this is from the Financial Times, showing, does the official data show gold has overtaken U.S. Treasuries as a central bank reserve asset? They say not quite, but almost. And Mike Philbrick talked about this, about how a lot of central banks were choosing to purchase gold instead of treasuries because of the fear of being sanctioned and having their assets seized. And I'm sure that's a part of it. It could also be fears of inflation. It could also be, fears of, we've gone through a really horrible bond market over the last 3 years. So all those things are kind of creating the perfect storm for, struggles in the treasury market, struggles getting people to buy treasuries at current interest rates, which is probably going to keep pressure on interest rates going higher, and which has been a total tailwind for the gold market, and the gold market just continues to chug higher. It seems like almost every day it's going up. It's really crazy. So we'll see where it heads. But at this point, a lot of crosswinds in the market.
Daren, it's about that time.
It is about that time.
The table has been set, and we've laid down the tablecloth, and I've got all the place settings ready to go, and all we're missing are the candlesticks.
The candlesticks?
Oh, I see what you did there, Dano. Nice.
That?
Pretty stylish.
Yes. We've already talked about, pumpkin pies, and we're setting tables. We're just going to skip over Halloween and go straight to...
God knows.
Straight to Thanksgiving.
Did the Halloween stuff come out like way early this year?
I was about to say Target's already skipped over it, so might as well.
I'm like, what on earth? It is. There we go. There's the tab I wanted to share. All right.
Let's get you up here. Bam, bam.
I thought we would start with NVIDIA. I mean, here we go again. We got a breakout in NVIDIA. And NVIDIA is sucking up. I think this week it became the first company in history to be a $4.5 trillion company. Let's see if it can take a $5 trillion mark. That's pretty insane when you think about it. I mean, it's just a juggernaut, and it's so massive. Now, you just have to wonder where it all ends. Or does
approaching
NVIDIA
8% of the S&P now.
8% of the S&P, huh?
Yeah.
You just have to wonder where it ends, though. So wild. But strong run. We're getting a breakout here. We had this bull flag happening, and we broke out. So here we go. Market. If this keeps going up, I think you can only expect the SPY or SPX, in this case, index, to keep moving higher, which is the largest 500 U.S.-based stocks. We closed at an all-time weekly high today. That's bullish. I guess we have to, there's victory laps, and there's we were wrong laps too. What are those called?
That's called the walk of shame.
Walk of shame.
So let me take a walk of shame here. Usually in September, the S&P 500 takes a dive, and has over the last few years. We didn't have it this year.
Mm-hmm.
Like, we just ripped through September. We had a little bit of a hiccup here in the third week of September. But other than that, we just plowed right over it. So we'll see what October brings. But typically, I'd expect some volatility with the government shutdown. But going into the end of the year, the market's usually pretty strong. And we made it through September. So that's, I think, pretty positive on its face. So here's me taking my walk of shame for you. S&P 500, this is the largest 500 US-based stocks. You can see NVIDIA. I mean, just so massive. And so think about the squares, and it's the size of capitalization compared to the other companies out there. And just absolutely sucking up all the oxygen out of the room. It's just phenomenally crazy and scary all at the same time. The NVIDIA is literally bigger than like the whole financial sector, insurance, healthcare, medical devices, diagnostics, all that. It's like twice the size of the oil energy sector, bigger than basic materials, utilities, real estate, and bigger than industrials. I mean, that's just the only thing is, I guess it's not bigger than communication services. It doesn't look bigger than consumer cyclical, but it is bigger in consumer defensive. And there you have NVIDIA, the juggernaut of the S&P 500.
So going back to our 2035 show, when our clone AI bots are doing
That's right.
this
We
show,
won't even have to do it.
does that square take up like 3/4 of the screen at that point?
Right.
Like, how big is the square then?
I don't know.
Or things to consider, Chris, things to consider.
27 times. It's currently trading at 27 times its sales. So it's revenue.
Things to consider,
almost
Chris.
28.
We can you guys hear me okay?
Yeah, sorry. I just kept interrupting you.
That's fine. No, totally fine. Something to consider, because it all is going this way and it's all seeming it's getting bigger and bigger and bigger. This sounds crazy to say, but there was a time in this country when if companies got too big, they broke them up. So I'm not saying that there's any indication of that, but I'm saying, as things like that all of a sudden pop up and exist, and it's like, oh, okay, well now that totally changes the chessboard, so who knows? But yeah, it's kind of, again, on our cycle theme right now, it's going big, it's getting bigger, and there's nothing stopping it.
Yeah, and it's hard to see the political will existing to stop it, right? Like, what would be the impetus behind stopping it? Nobody wants to stop the music and be the one without a chair politically. And I think you've got that kind of scenario right now where, like, who's going to touch, what politician is powerful enough to touch a $5 trillion company?
Mm-hmm.
It would take some kind of extreme event.
And I'm not advocating for that at all. I'm just saying it's always interesting to me that
even Dan's scared to advocate for it. I mean,
I always think it's interesting when something's going one way and everyone's just like nodding the same, like, oh yeah, no, this will never change. And then like they have amnesia, and then when the change comes, they're like, oh yeah, well the change is here, okay. And there's never during the nodding period do they acknowledge like, oh, hey, this could happen, potential like things that could cause this from, just being up and to the right every time. So it's interesting. Just interesting.
Yeah, it is. Well, and I think that's the opportunity to step back as an investor, when everybody's on one side of the table going, yes, 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 to be like, okay, and what's the rest of the story here, right?
Exactly.
It's really hard to do, though, because when a stock like NVIDIA is soaking up all of the money in the value in the market, like if you had NVIDIA in your portfolio, it looks great. If you didn't, it doesn't. Like, and that's a hard pill to swallow. Diversification is a very hard pill to swallow in these moments. Because it feels like it's going to go on forever. It won't go on forever. It will end at some point, and it's probably going to end in a pretty ugly way when it does. What will be that impetus will be the lack of power to continue fueling the growth. Because I think that's ultimately the factor that stops AI is that it just can't keep growing the way it's been growing. And then everybody figures out like, oh, okay, now let's figure out where the emperor with no clothes is and where the house of cards was. And then when it falls apart, and then you get that S curve of adoption, and then it really does change our lives in a pretty drastic way. The owner of Amazon, or founder of Amazon, Bezos, was saying today, he's like, he really believes that AI has created an industrial bubble, in the bubble in electronic parts and building these gigafactories and all these things. So eventually the music stops, and there's going to be some people missing the chairs. At that point, though, I think then we really start to see AI shape and change our life in a way that I don't believe will be even recognizable from today as we sit. It will be drastically different. So let's talk about Bitcoin. So we've seen Bitcoin going up. We've seen gold going up. We see NVDA taking on all-time new highs. And here goes Bitcoin with that kind of bear flag breakout, just like in the just like NVIDIA just did, but similar. So you can see this kind of stable, this consolidation pattern, and then breakout. If history precedes itself, I would expect to close at 5 o'clock. It looks like it's going to close at all-time highs at 5 at 122,000 per Bitcoin. Far cry from these days. I remember these days very, very well. I remember this. This is why when Chris says, "Oh, you can take your victory lap," nope, because I've been through this, and I've been through that, and I've been through this, and I've been through that. So you just roll with it, and no highs, no lows. It is what it is. Let's take a look at the bond market. So the bond market continues, and I think if there's any asset class that has quietly come back in vogue this year, it's been the bond market, right? Like nobody's calling us saying, "Hey, do you look how good my bonds are doing?" Said no human ever. And but we're back now to the 2022 kind of high. We've broken into this whole neckline area. Be interesting to see how it does now, but let's just say hypothetically we get a market down and some risk off sentiment, you could really see bonds shooting up here, and there's some room to be made up for in the bond part of the portfolios. And it's looking like that's something that's in the cards at this point. All right, let's take a look at we'll take a look at RSP, which is the equally weighted index, and I think this is also good news. SPX broke out to all-time new highs, and so did RSP, which is the equal weighted index. That is the index that tracks and makes all these boxes the same size. And that index broke out to an all-time high. That means there's pretty broad participation, where it's in past, it's just in like NVIDIA and the 7 others. A lot of green on the screen. There's a lot of companies doing really well right now. The oil chart, though, is peculiar and maybe signaling something. You can see we're right down along this primary support line that we've been hanging out in for a while, and continue to kind of have downward pressure on the oil markets, which could either be a sign of too much supply coming online. It maybe with geopolitical tensions calming. It looks like as of today, we're going to get maybe some peace out of Hamas in Israel, and that could quiet down the Middle East, which would then allow more supply to come online. So that's interesting, but definitely putting downward pressure, either supply or the oil markets are saying actually things are slower than they look. I do think we're in this kind of tale of two cities again. Chris, I remember talking about that coming out of COVID. It was a tale of two cities, and that's when we saw BLM happen and some of these other kind of social things fomenting. And interestingly enough, we're seeing that foment happen now with the ICE raids and the protests with those, and some of the Hamas stuff and Palestine. You tend to see social things exacerbated when there's groups of the population that are under more economic strain than others. And I think anecdotally, in talking with people who are in the lower income echelon of society, there is financial pressure there right now. And that's a very different experience than those who own capital markets like that we talk about day in, day out, like the stock market, the bond market, the Bitcoin market, etc. So I think that is why we're seeing the social stuff kind of come to the surface even more. And there's usually an economic reason for sociological kind of blow-ups. And you can see the dollar has really, this is DXY in juxtaposition to the other currencies. The dollar has really gotten just pounded, which has actually helped our mid-cap stocks do better this year, because when the dollar is going up, and it's really punishing to the mid-cap stocks. But you can see this year, give or take, the dollar is down about 11% compared to another basket of currencies, while gold taking a massive victory lap. Gold looks like a tech stock, YOLO, crypto chart. I mean, I think I did this last week. Didn't I pull this up? And I'm like, what stock is this? And it's gold.
Yeah.
It looks completely like a YOLO
I think maybe
chart.
a couple weeks ago, but yes. And silver's looking very similar.
I think
It's
with silver,
interesting that it's done so well, and it's done so well for so long, and yet I don't know about you, but I'm still not really getting many questions about it. I mean, I'm okay
None.
with that. Like,
None.
I don't want people storming me, but it doesn't seem like you're getting a lot of chat about gold, even though it's crushing AI and gold miners. Poof, wow. I mean, AI gets all the press, but man, you look at what's going on in the gold and silver market, and it's pretty wild.
I still think, and this is just really a personal opinion talking to people, so grain of salt always, but I think there's a disconnect for people between buying gold and buying a gold ETF and all of the various ways to buy gold. And so some people still conceive of gold as the infomercial, and I'm buying a physical bar and then I'm hiding it somewhere. And I still don't think people see it as like just another equity on the, that you can buy on a trading platform. So I think that kind of breeds. I don't think, Chris, that they think of you as someone they buy gold from. I think they think they have to. You need a 1-800 number, bro, so they can call you to get their gold.
Yeah,
you need a 1-800 number and a full page ad in the New York Times.
That's right.
Then
At Costco. At Costco. You need to be at Costco, Chris.
No, thank you.
And then the
No,
world's
thank you.
ending, and they're playing on some type of fear in order to get you to buy gold, right?
Right.
Yeah, and that's what I kind of go back to. Like, I distinctly remember those first couple weeks during COVID where, you're in the grocery store and it feels very apocalyptic at that point. Like, everybody's covered up and everything, and the shelves are all empty. And I literally thought to myself, I'm like, what if I wanted to pay with gold right now? Like, what if that was the only way? Like, I don't feel like that would be appropriate at all. Nor would I even feel safe walking around in that environment with like a bunch of gold in my pocket,
And Daren's got his public and his private keys on him, so he's worried about his Bitcoin passwords. Though there's all kinds of manner of protection going on.
Yeah, Dan, thanks for that. Let's talk about the VIX. So the VIX is a measure of it's basically a indicator of how complacent those who trade the futures on the S&P 500 are. And so in theory, the market tends to work higher while the futures market is more complacent. And when they get excited, that's because things are going down. And so these big spikes, this was the tariff tantrum we had earlier in the year. This was COVID. This was 2024. I'm trying to remember what that was on 2024, what people were worried about then. So you can see kind of this panic happening in the VIX when people start tripping out. But the fact that kind of volatility settled down into that 14 zone, usually we get some kind of spikes after that, right? So because the S&P 500 is run so hard, so fast, like you look at that, that's a pretty hard run, pretty quick. makes me suspect we'll probably get a pullback, but I thought we would in September. I thought that was going to be the correction going into the end of the year. Please don't tell me we have another December correction. That was like the worst year in 2018, Chris, when we had a December. And that's what happened last time Trump, won, is we had a bad December. I hope that doesn't repeat. That would be just not fun.
I was told there would be Santa Claus rallies, and that's what I expect. And
if there is a bad December, it's not his December. It was somebody else's December. It was the worst December. I've never had a December like this December. That will be the answer if we get a bad December.
Yeah. So anyway, overall, things look pretty bullish out there. I don't see anything under the hood that's saying, let's run for the hills, other than the fact that this has been going on a long time, and you would think there's a correction in the near future. So I think we'll leave it there for this week, and I hope everyone has a great weekend. We're getting some great rain in Northern California, which is awesome because fire season is probably officially over at this point. Pretty hard to start a big complex fire when you get rain like this. And with that, take care.
Daren, Chris, thank you for a great show. Thank you for checking us out. We are Sonoma Wealth Advisors. You can learn more about us at sonomawealth.com. If you're a client, you already know us very well. We thank you for following along this far. If you're new to our firm and you want to learn more, find out what we do for our clients, sonomawealth.com is where you can take our free wealth analysis. Wherever you're listening or watching us right now, make sure to subscribe. It really helps the show, and it helps you catch up, and you won't miss future episodes. And of course, you can find us YouTube, Apple Podcasts, Spotify. Past episodes are there as well as other podcasts. So thank you so much for checking out On the Markets, and we will see you next week.
Fermata Advisors, LLC is registered as an investment advisor with the SEC and only transacts business in states where it is properly registered or is excluded or exempt from registration requirements. This content was produced by Fermata Advisors, LLC, DBA Sonoma Wealth Advisors, DBA Fermata 401k, DBA Fermata Tax, DBA Fermata Insurance. The opinions expressed by Fermata Advisors, LLC on this show are their own. Information presented on this program is believed to be factual and up to date, but we do not guarantee its accuracy, and it should not be regarded as a complete analysis of the subjects discussed. Discussions and answers to questions do not involve the rendering of personalized investment advice, but are limited to the dissemination of general information. A professional advisor should be consulted before implementing any of the options presented. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Viewers and listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance.